still tuned into the Power Station Energy 100. We are busy with Economy Chat. Let's talk business with Mr. Daniel Steinman, who is the editor of The Economist Namibia, and also, of course, as you have noticed, that he is also I don't want to use the direct term or position or your profession because you seem to not like it when I say that. How would you describe your...
I'm very scared of so-called experts with huge labels. I tend to pay attention when somebody opens his mouth and to assess the ability of an individual on the strength of what he or she says.
Okay.
Yeah, because that's always an indication. Are the wheels up there turning nicely, or are they stuck?
Are they messed up?
Are they messed up, yeah.
But, of course, Mr. Daniel Steinman, you've become a teacher to our listeners when it comes to the economy. I would give you that position when it comes to our listeners. You have become the teacher, and you continue teaching us and you educating us on our economy in Namibia. But I will not want to drag on with this. We are talking about liquidity. Before we went on a break, you left us on the tip of our couches. So we want to know, where did that come from? Where did this money come from?
Okay. There are two. Again, there's a spectrum of activity, which I will try to put into context or make it understandable in a very simple, straightforward way. I believe that a very large part of the liquidity comes from the so-called capital market.
Okay.
And this is where the government sells its debt. In other words, where the government finances its own operations. Now, for the better part of 7, maybe 8 years, from around 2014, let's make it 2015, so now we're talking 7 years. The government was what we call a price taker, meaning it had to sell its debt at whatever the market, the private sector players, the institutional investors, whatever they offered. Now, a government bond works on a discount principle. So if I'm the government and I want to borrow $100 from you, Elsabe Tibanyani, I say, Elsabe, give me $92 now, and in 4 or 5 or 6 years from now, I'll give you $100 back. Do you see that weird mechanism? It's a strange form of accounting. It's called the discount principle. So the government gets, when it sells a bond or when it sells a tranche in a bond, and let's say it's 100 million, because these are typically the type of figures that you're talking about. They would get in 92 million. And then there's a coupon rate. And coupon rate is the interest that you earn on the government debt every year, and it's usually split into 4 quarters. So we call this fixed interest investments, and it's a very important part in, for instance, in the retirement planning of people on pension, because they want to know, I'm going to earn on this investment so much and so much and so much from government bonds. But be that as it may, and I'm trying very hard not to become a college professor here, not to get stuck or drowned in technicalities. It means that the bond, the money that you give the government, you pay a certain, you see it in a certain value framework. So given the discount principle, our bonds were relatively cheap. So if the bond is cheap, it means that part of the $100 that the government must give back to you is bigger. And if the bonds are expensive, it means the yield is higher, but the initial investment is smaller. So this is all a bit. It's like when you in Standard 6, when you do accounting for the first time and you try to get behind debit and credit. You know, and if it flows in that direction, it's one word, and if it flows in another direction, it's a different word. So it's very similar to that. But to make a long story short, what I've been noticing since about November last year is that the government bonds have become more expensive. Now, keep that in mind, what I've just, this big explanation.
Yeah.
But it means that the government borrowing is becoming cheaper. So the government is slowly morphing from a price taker, what I said, they had to take at whatever rate was offered, to a price setter. They now, to a very large extent, determine the interest that they want to pay. And you can see over the last 6, 7, 8 months how that long end of the curve, we call it. So this is now the government's liabilities 10 years, 15 years, 20 years out from now, how that interest rate is coming down. So the bond is becoming expensive, but the implication is that the borrowing for the government is becoming cheaper. You understand that part?
Yeah.
And that created well, now you have to ask yourself why. And I believe, and I cannot prove this, and I don't think anybody can prove this, I believe that foreign investors are entering the Namibian capital market. Why? Because of the positive news of the oil discoveries. Yeah. All of a sudden, Namibia is seen as a good investment destination. And what is the most obvious? Remember, if you're a foreign investor and you want to come invest in Namibia, you have to go through 1,000 different companies. Which one is okay and which one isn't? Or you go to the stock exchange, you see what stocks are listed, and the liquidity on the stock exchange is very low or very tight. You don't get, it's difficult to get Namibian companies to invest in. But Namibian government bonds are available all the time. And every week there's a new issuance. You know, so it's a very liquid market. And the way that the government has developed it and how it rolls it over, making the short-term debt or turning it into long-term instruments, has improved the liquidity. So I believe that the Namibian capital market has become very attractive to foreign investors, and I see this, it's corroborated by the fact how I see the interest rate, especially the long part of the curve, coming down, and fortunately there's always a benchmark, and that is the bonds in South Africa. You can always compare our bonds to the very similar bond in South Africa, and there's always been a spread. You know, our government borrowings was more expensive. Now it's become very small. That spread, and I think this is where the liquidity comes from. And as a parting shot, the reason why it's now so apparent in the statistics is, despite the fact that there's a lot of money in the system now, the private sector still does not want to borrow because of the damage that they suffered from the recession and from COVID.
2016.
So the private sector is still scared. The money is there, but it's not finding its way into productive investments, and I think this is what we can talk about when we meet again.
Yeah, definitely. And on that note, it was a very interesting conversation, talk for me, and I'm sure it was for the listeners as well. But like Mr. Daniel Steinman said, we will continue this talk again next time we meet again. But thank you so much for keeping it locked to the Power Station Energy 100. This was Economy Chat. Let's Talk Business with Mr. Daniel Steinman, with your hostess, Elsa B. Timiani. Till we meet again next time.